everyone, welcome to the Analyst Classroom. Today we are going to learn about the long-lived assets. So in the long-lived assets, we are going to discuss about the capitalized cost versus expense cost, goodwill, depreciation methods like straight line method, double declining balance method, unit of production method, and then amortization and impairment, then revaluation method and derecognition of the PPE. So let's start with the capitalized cost versus expense cost. So there are two ways to account for the cost in the financial uh, reports. The first is to expense it, and then the second is to capitalize it. So let's check when companies expense cost and when companies capitalize its cost. So when the expenditure that is expected to provide economic benefit is capitalized. So if a company's expenditure is expected to provide its economic benefit for the longer time, then company capitalize it. And if a future economic benefit is unlikely or highly uncertain, then expenditure is expense. When future benefit is not there, then company directly expense it. How company capitalize? So company record that cost as an asset in the balance sheet in the capitalize. For example, let's uh, discuss this also. So when capitalize, company record asset in the balance sheet, and in the expense, company record that expense in the income statement. For example, I spent 50 towards the research and development. So if I want to expense it, I just directly show as an expense in the income statement, and my cash will reduce. And if I want to capitalize, I will generate asset in the balance sheet name called R&D asset of rupees 50, and my cash will be reduced. And I won't mention any expense in the income statement, and this asset will be depreciate over time. So if I know that my research and development will uh, give me the economic benefit, I will capitalize it. And if I'm uncertain about the future economic benefit, I will expense it directly to the income statement. Then interest interest that accrues during the construction period is capitalized, and interest paid after the construction period is expense. So let's understand these also. It means that if I have taken a loan for the specific motive, for example, I have taken a loan of 100 rupees for 5 years specifically for construction. So how will I account for this is, for example, I have taken a loan of 100 and then started constructing a building. So in the first year, my building is in work in progress. Second year, it's also in the work in progress, and in the third year, end of the third year, it's become the operational. So I have 100 rupees of loan, and I need to pay interest on that loan also. So I will have the first year 10 rupees, then it's cumulative 20 and it will be 30, and this is my principal and this is my interest. So my I have taken a loan and I need to pay interest on that loan also. So these both will be my cost of construction. So I will show these in the asset side as a capital working progress plus interest capitalized. These both will show as a asset side during the construction period, capital working progress, and then when my building is operational from the fourth year, I will show as a building asset, and these cost will be 130 rupees of both loan and the interest both, because I have specifically taken the loan for the construction period. So all the expenses regarding the building construction, I need to be capitalized. So my capital interest during the construction period I will capitalize, and then these 2 years I will s- expense out the interest in the P&L and only show the building, because my building is now operational, so it's not related to the building. Then that's it. Now let's discuss about the measurement base for internally generated intangible asset. So intangible assets. So there are accounting standard according to the IFRS. Research cost should be expense and development cost should be capitalized. So if you are researching on building a product or any intangible asset, you need to expense out, and if you are developing that product or intangible asset, you could capitalize in the development phase. But US GAAP says that research cost and the development cost both should be expensed. Can't capitalize research and development cost except except software cost. Software Particular software cost are treated as the IFRS, that in the US GAAP you could capitalize development cost of the software and the research cost expense. So you in the US GAAP research cost of development of the research cost you could capitalize. Then we will discuss about the goodwill. So let's understand the goodwill. So suppose I am a acquirer. This is my balance sheet: equity 500, PPE 200, investment 100, and cash is 200. And this is the company I want to acquire. So his balance sheet says equity is 100, bank loan is 100, goodwill is 30, PP is 120, and inventory is 50. So I decide to buy 100% of this company at the rupees of 200. So when a company buys any company, they don't directly show his book values in his books. Rather, he goes to goes to the market and decide and calculate its fair value of net identifiable asset. So I'll check the fair value of its asset, and then I will show that assets or liability in my books. So while checking, I found that the goodwill has no fair value. PPE has 200 of rupees of fair value, but he show as only 120. My inventory fair value is same as his, so my fair value of net identifiable asset became 200 plus 50 minus 100 rupees of bank loan. So its business worth is only 150 rupees, and I have paid the consideration 200. So I have paid extra 50 for the good if his goodwill. Goodwill means goodwill is an intangible asset that represent a excess value paid for a business over its net assets during the acquisition. It includes the factors like brand reputation, customer loyalty, intellectual property, and business relationship that contributes to the company's earning potential beyond its tangible asset. It gives the company some benefits. So now I will report my consolidated books. His equity is same as the 500. I will show the my acquired company's bank loan. My goodwill will be 50, PPA is 400, inventory is 150, my 100 is mine and 50 is his. My cash is paid for the acquisition, so my cash will be the zero. And goodwill is always recorded only when it is acquired. Internally generated goodwill not recorded in the books. It means if I spend any money towards generating a goodwill, for example, I do charity, I will do any other social works that could generate goodwill for in the customer mind for my company. I can't show that expense as an asset or as a goodwill as an internally generated goodwill. Goodwill should only recorded when it's acquired M&A transaction. For example, I have purchased a 150 rupees company as a 200. My excess paid will be goodwill for that company. So this goodwill is not mine. This goodwill is this acquired company's goodwill. It's not mine. Okay. Then goodwill has a definite life. So no amortization of goodwill, but however it can be impaired over time. So goodwill has indefinite life. We need to check for the impairment. Then the another scenario comes. For example, I acquired I acquired the company worth of 70 plus 5150 rupees worth of company I acquired for only 75 at 100% stake. So my goodwill will be minus 45 because my this company's PPE is 70s and inventory is worth of 50. So 50 rupees 50, 150 rupees company is acquired with only 75, so I have less paid 45. So this is negative goodwill. So this is this A difference is directly shown it as a profit in the P&L. This less paid is my profit. I can't show this as a negative goodwill. Okay, then let's discuss about the impact of capitalization on the various ratios. So if I capitalize certain expense, as we have discussed here, expense versus capitalize, how it will impact the company's financial ratios. For example, if I capitalize, my total asset will be increased, my liability will not have any change, my equity in the first year will increase, as ex- I have capitalized instead of expensing that in the P&L. So my equity is the part of retained earning and the shareholder equity. So my profit will be the higher and my equity will be the higher. In the subsequent also it will be the higher because it's a cumulative. It's the cumulative the equity part. For example, I have first year capitalize it, so its profit is more than in the second year also. So my subsequent year profit equity will be the higher also. My net income first year will be the higher on the year of the capitalization, and in the second year my net income will be the lower due to the depreciation of that asset. Capitalized company will have a depreciation on the net income, and non capitalization company, expense company, will not have any depreciation on the well, P&L. So it's capitalization company has the net income lower. My CFO will be the higher, as I have shown this in the will capitalization company show that cost in the cash flow from investing. So cash flow from operation will be the higher and cash flow from investing will be the lower. Financing cash flow will no change and total cash flow will have no change. Interest coverage ratio will be the higher, as my EBITDA will be the higher. Interest coverage ratio will be the lower in the subsequent year, and debt to equity will be the lower, as my equity will be the higher. Now let's discuss about the depreciation method. So in the depreciation method there are three main methods: straight line method, double declining method, and the unit of production method. So, and there is one concept called com- component depreciation. Component depreciation means depreciating component of the asset separately. For example, in case of the building, you depreciate flooring, roofs, walls, etc. are separately. For example, you depreciate 10 rupees of 10% in the flooring, 5% in the roof, and 50% in the walls. So different you separate out the one big asset into subset, and you do component depreciation. So component depreciation is required in the IFRS, and the US GAAP component depreciation is allowed but not required, and it is but is seldom used, means rarely used in the US GAAP companies. And then comes the economic depreciation, actual decline in the value of an asset due to the economic factor. Now let's understand the straight line method. So in the straight line method, suppose I have asset acquisition cost of an asset 100, useful life of 4, and my salvage value, scrap value is 20. So I will depreciate over a year 100 minus 20, 80 divided by 40, 20. 20 rupees I will depreciate every year. So my first year depreciation will be 20, closing is 80. Second 20, 60, 20, 40, and 20, 20, closing 20. My in the fourth year, my closing value of the asset will be 20. That will be the salvage value. I depreciate same value every year in the straight line method. In the double declining method, for the same asset, I will I will depreciate with this formula. My opening is 100. My opening book value divided by total useful life into 2. So my 100 is the opening value, or divided by 4 is the useful life into 2. 50 will depreciate in the first year. My closing value will be 50. In the second year, 50 divided by 2 into 225. I will appreciate 25 is the closing value. In the third year, if I depreciate via this formula, my depreciation will be 12.5, but it will reduce my closing value below my salvage value. So what will I do is 20 is my salvage value and 25 is my my carrying value of an asset. So 5 is my depreciable amount. So uh, uh, I decide to spread it out to the 2 years, or I could depreciate in the 1 year also. So in this example, I spread it out in the 2 years of 2.5 and 2.5, and I will remain this 20 as a salvage value in this. So in the double declining balance method, you need you need to do this kind of adjustment in the later year also to comes to the salvage value. Then let's discuss about the unit of production method. This is the suppose I have bought a machine worth of 100, useful life is 4, salvage is 20, and it's a coffee machine. So it will provide the 80 cups of coffee over a lifetime. So my depreciation value divided by production capacity. Okay, so my value depreciation value is the 80, and my total production capacity is also 80. So my depreciation uh, per cup of coffee will be 1. It means if I produce 30 cups, I will depreciate 30 rupees from the asset. My closing value will be the 70. If I produce 20 cup, I will depreciate only 20. 50 will be closing. 10 cup of production will have 10 rupees of depreciation. Losing is 40, and the fourth year 20 cups of production, 20 rupees of depreciation, and closing will be the 20. So in these methods, you depreciate asset on its production. Now let's understand the impact of the depreciation related assumptions. So as compared to straight line method, using double declining method result in the higher depreciation. As we have checked, it's depreciate half of the asset price in the first year and 25% in the second year. So it will it will it will impact higher depreciation and this cause the lower net income, lower ROA and ROE. My asset will be the lower and my profit will also will be the lower, and there is no impact on the cash flow because it's a non-cash expense. And the estimating lower salvage value or less useful life also result in the higher depreciation. Then comes to the amortization method. Amortization is the same as the depreciation of the intangible asset. We 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 depreciate the tangible asset and amortize the intangible asset. These concepts are the same, but these are the different words used for the different types of asset. For the tangible, we call the depreciation, and for the intangible, we call the amortization. So intangible asset with the finite lives are amortized over their useful life, just like the depreciation. Its methods are the same as the depreciation, SLM, DDB, and the unit of production. And the choice of the amortization method affects the component, asset, equity, and the financial ratios, just the same with the choice of the depreciation does. This how it's affect the ratios, same as the depreciation, but for the intangible assets. Then let's discuss about the revaluation method. So that there are two types of the method showing the showing the value of the asset in the balance sheet. There is the cost method and the revaluation method. So generally we are using the cost method. The long lived asset are also reported at the depreciation cost of the acquisition, and uh, depreciating over the time. And the revaluation method, in the revaluation method, long lived assets are reported at the fair value of the asset. So in the revaluation method is permitted only in the IFRS, not in the US GAAP. And the revaluation can be used it as an active market, and use revaluation method can be in used in the asset which has active market exist for that asset. So in the reporting balance sheet you show the fair value. In the revaluation method you will you will show the fair value in the balance sheet, gains of that asset in the OCI, and the income statement, loss in the income statement. So let's understand with the example. For example, I have 100 rupees of asset. In the next year I check and its fair value is 120. So 20 rupees of gain I report in the OCI. In the next year it's come down to the 70. So I have the 50 rupees of loss. So what will I do is I reverse that OCI last year gain. So I will subtract the 20 rupees from that OCI and 30 rupees as a profit in the income statement. And in the second case I have 100 rupees. In the second year my asset of value of the assets come down to the 80. So I show the loss in the P&L. And in the next year my my value of an asset increased to 150. So I have gain of 70. So I spread out 20 rupees last year loss is reversed in the P&L, and 50 rupees of profit reported in the OCI. Okay, so the core concept is gains are gains are shown in the OCI and loss is shown in the income statement. But last year gain or loss should be reversed from the subsequent mm, sections or the reports. So in the under the IFRS, can revaluation model can be applied? Yes. Tangible asset? Yes. Intangible asset? Uh, Conditional? Yes. Condition is a certain type of tangible. Certain type of tangible means level 1, and level 1 type of asset is means that ready market prices available for the that asset. You could decide the price of that tangible asset. Then let's discuss about the impairment of the PPE and the intangible asset. So the impairment means one time reduction because of the significant decline in the market value of an asset. And depreciation means a systematic reduction in the value of an asset. Systematic reduction we do, and we check for the impairment for the one time reduction because of any significant decline in the market value of an asset. Impairment, IFRS and US GAAP has a different rules. For example, if you are doing the accounting in the IFRS, you need to check the carrying value versus a recoverable amount, and the higher of the two will be shown as the impairment. For example, my carrying value is less than the recoverable amount. I will show different differential amount in the impairment. So my impairment will be carrying value minus recoverable amount, higher of the two. Recoverable amount is higher of NRV or value in use, present value of the future cash flow. We check the net realizable value means selling price minus selling cost, realizable value. Or in the value in use means we check the future cash flows of the asset, and we will calculate the present value of that future cash flow. In the US GAAP, we first ask if impairment is required or not, and if required, then uh, the we'll check by the if the carrying value is a less than of total undiscounted cash flow or not. If not, then we will not impair, and if it's less, then impairment will be the carrying value minus NRV of PV of the future cash flow, net realizable value, or present value of the future cash flow. NRV is preferred. So let's understand. Under the US GAAP, impairment cannot be reversed, and under the IFRS, impairment can be reversed but only to the extent of the previous carrying value. So let's understand with the example. In the IFRS, I have bought the ice cream vending machine. I have purchased for the 1 lakh rupees 5 years ago, and accumulated depreciation is the 1 lakh. So I have two options: I sell or I use. So if I sell, my selling price is 40,000 and my commission on the selling is 5. So my net is realizable value is 35k. And if I use, I I will I will generate these cash flows over the 5 year, and this cash flow is total is 60k. 50, 50, 45, and 60. So 60k is undiscounted, and if I discount at the rate of 10%, I will have the PV, present value in use is 43.6k. So I will ask the question, if is my recoverable amount is less than the carrying value? Yes, my recoverable amount is 46 and my carrying value is 50. So I will charge the impairment 50k minus 43.6, and my 6.4k will be my impairment, and will show I will show in the P&L as a expense. Okay, in the US GAAP. For the same example, I will ask the question, if impairment is necessary, and if necessary, for example, my carrying value is 50, my undiscounted cash flow is 60, my cash future cash flow is greater than my carrying value, so take it easy, knowing impairment required. I will not check the present value of that cash flow. I will just check the my cash flow will is higher or not. If higher undiscounted cash flow, I don't impair. I will not impair. Let's understand the second example. In the second example, gross block is 1,20,000, accumulated depreciation is 40, selling price is 65, selling cost is 5, total undiscounted cash flow is 72,000, and my total discounted cash flow is 58. So in the IFRS, my carrying value is 80 net block. My carrying value is 120 minus accumulated depreciation. 80 is my net block versus recoverable amount. Value in use 50, 58k is my discounted cash flow, and net realizable value is 60. 65 minus 5. Selling price minus selling cost is net NRV. I will I will compare CV versus recoverable amount. Recoverable amount is higher of any two, NRV or the value in use. So NRV is higher than this, so I will consider NRV as my recoverable amount. So my carrying value is 80, my recoverable is 60, so 20k will be my impairment, and it is reversible. In the US GAAP, I checked the carrying value 80 versus total cash flow 72, undiscounted cash flow 72. Okay, so is my seven my undiscounted cash flow is lower than the carrying value? Yes. Then I will impair. Is impairment necessary? Yes. So 80k will my carrying value was versus NRV 60k. NRV is always preferred over the present value of the future cash flow. So my NRV is 60. So here also 20k will be my impairment, and here impairment is not reversible in the US GAAP. Then we will discuss the derecognition of the PPE. Derecognition of the PPE. So in the derecognition, there are three uh, three reasons for the derecognition. If I have sold my PPE, I have exchange, or I have abandoned my PPE. So in the sold, asset is removed from the balance sheet, and gain or loss is reported in the P&L. In the exchange, new asset is recorded at the fair value, and gain and loss is computed by computing the CV and the fair value of an asset given up or acquired. In the abandoned, asset is removed from the balance sheet and loss is reported in the P&L. That's it. And the impact of the impairment, revaluation, and derecognition on the ratios. Impairment causes the PAT, asset, equity, ROE, ROA will decrease due to the impairment loss. Asset turnover will be the higher as I have less uh, say, sales on the lower asset. My asset will be the lower. Subsequent period PAT and ROE and ROA will increase. In the revaluation method, upward revaluation will increase the asset and equity. Asset turnover will be the lower due to the increase in the asset. Debt to equity and debt to asset will decrease. Derecognition in case of the loss, PAT and asset will decrease. Turnover will be the higher. In case of the gain, PAT and asset will increase. ROE means net profit divided by asset, and asset turnover, sales divided by assets. Required disclosures. So the required disclosure in the required disclosures, carrying value for each class of asset should be disclosed. Accumulated depreciation and amortization should be disclosed. Title restriction and the asset pledge as a collateral. For impaired asset, loss amount and the circumstance that caused that loss should be disclosed. For revalued asset, IFRS only, the revaluation date, how fair value was determined, and the carrying value using the historical cost model also be disclosed in the financial reports. And then comes the useful calculation for the analyst regarding the asset. So if you need to check the average age of the asset, accumulated depreciation divided by annual depreciation will give you the age. Total useful life will be calculated by gross block divided by annual depreciation expense. Remaining life of the asset, net block divided by annual depreciation. Let's understand with the example. Suppose I have a building, gross block is 100, accumulated depreciation is 40, net block is 60, depreciation for 10 years. So total life of the building is 100 divided by 10. 10 years of 10 years. Age is calculated by accumulated depreciation divided by age. 4 years is the age of the building, and the remaining life is net block divided by depreciation value. 6 year is the remaining life of the building. And then comes the investment PPE. Investment PPE works only in the IFRS. So in the IFRS, property hold for the rental income earning capital. Property hold for rental income earning capital, appreciation, or both. So if you hold any PPE for the rental income and earning capital appreciation or both, you could show as the investment PPE in the IFRS only. In the US GAAP does not distinguish investment PPE from the other long-lived asset. It doesn't uh, allow you to distinguish investment PPE or any other PPE. IFRS allow use of the cost model or the fair value model to calculate the value of the PPE. The fair value model is similar to the revaluation model, except gain are also taken into the income statement. No, that the you remember that the revaluation model gains are reported in the OCI. Here it's in the income statement. So in the suppose you have a IFR company, you purchase a building, you decide the purpose. What's the purpose? Use or the investment? If you are buying the company for the use, you do the regular PPE account as a regular PPE. And if you have a investment purpose to earn a lease or earn a capital appreciation, it will be your investment PPA. So the accounting for the investment PPA will be cost model same as the regular, and the fair value model same as the revaluation model. Revaluation model same as the revaluation model. Fair value is revaluation model same as the revaluation model, except the gain are also recorded in the income statement. So that's it. This is the comprehensive understanding and explanation of the long lived assets. Thank you for listening. Have a good day.